Thank you, Professor Rogers, and thank you all for coming this afternoon. This afternoon, the presentation that we've put together is taxation. Can't live with it, but we can't live without it. So with that, we'll begin. So as Professor Rogers began, my name is Alfred Petross. I am a senior School of Business student that has studied accounting, leadership, and taxation.
I'm Rugg. I'm a senior as well. I've studied general business and taxation.
And I'm Taylor Crowther. I'm a junior here. I'm double majoring in accounting and finance with a minor in taxation. And all three of us plan to eventually continue our education in the tax world. So this is one of the reasons we're putting this project together, is to further expand our knowledge as well as convey what we've learned to you.
So, I'm sure you've heard this famous quote by Benjamin Franklin. In this world, nothing can be said to be certain except for death and taxes. We all have to pay them at some point. Every state demands them, or every country as well.
And then I don't know how many science-oriented people we have in this room, but one of the greatest minds in history, Albert Einstein, is quoted as saying the hardest thing in this world to understand is the income tax. So of all the things Albert Einstein's thought of, he has mentioned that this is the most difficult to understand. So I thought that was interesting.
And that is the very purpose why we've assembled this presentation, so that we can help to explain some of the individual tax systems here within the United States. So some background information. From 1791 to 1802, the United States was supported by an internal sales tax. What that was on sales of carriages, auction of property for estates, there was sales tax applied to each of those sales, and that's how the United States government would function. Now, it wasn't a very good process to receiving taxes, so after the World War of 1812 and during it, the nation's first sales tax was instituted all across the board, so that there would be guaranteed receivable and payment by taxpayers to be able to fund the United States' involvement in the War of 1812. The next war that the United States eventually came to become involved in was an internal conflict. In 1862, the United States was faced with a civil war, and the United States government was required to enact a first income tax system into the country's financial system. And that was essentially a 3% average to all taxpayers that they would pay on their net income. Today, the highest income tax bracket is at a marginal rate of 39.6%. So huge difference from 3% to 39.6% at the very highest. In 1913, the 16th Constitutional Amendment was ratified, making income tax policies a permanent fixture within the United States government. And in 1944, the top tax bracket peaked at 94%, and that was ultimately a result of the United States' involvement in World War II. And then again, in 1986, President Reagan lowered the highest tax bracket from 50%, which was placed at that level in the mid-1970s, down to 28% of an individual's net income. So that is, in most recent history, the lowest income tax rate that we've seen. Here's a detailed graph showing by different presidency what the income tax rates have looked over the years. As we can see, during the Depression era, the income tax gradually increased to the point of World War II, and then into the Korean and Vietnam War, and then slowly came down with the presidency of Ronald Reagan, increased with Clinton, and then came back down to what we traditionally know as the Bush tax cuts.
All right, so we want to jump into our modern day tax system. So I don't know how familiar you are with our current taxation laws. I mean, they're super complex. Some people study all their lives and never understand completely. But here's kind of a breakdown on our standard deductions and then the tax brackets. We just did single and married filing joint. So kind of standard deduction is set by the government on saying each one of us is guaranteed in 2015, this is 2015 law, as a single individual of $6,300. So it's an automatic, I'd say like a haircut or a deduction off your adjusted gross income, which you will get to eventually your taxable income.
In addition to that standard deduction, you also have personal exemption amounts. For 2015, Congress and the IRS have enacted that amount is going to be $4,000 even across the board. So traditionally, students will oftentimes say that their parents are claiming them, or if you're a dependent of another person, the person that you're a dependent of is claiming you. What that means is that you're going to allow that individual to use an exclusion rate of $4,000 towards their income tax return for providing more than half your own support, so that they have $4,000 worth of essentially tax-free income. As you move up and slowly make more of that adjusted gross income, you have a phase out where all of your exemption amounts will be disallowed. So the exemptions and standard deductions essentially give you a waiver and exclusion amount on certain amounts of income that you make, and then for the first dollar above that amount is when you begin to make the pay taxes on your marginal tax bracket rates. So before you, we've also given the judges, I apologize for not giving all of you, but we will illustrate the numbers up on the board. We've given a tax scenario. What we're going to do is we're going to take this information and place it onto an individual's tax return. This isn't anything too complex. We're going to identify wages. Let's say this individual's a professor here at Adams State. Entry level, making $50,000 a year. They also receive interest on their bank account in the amount of $50. They have invested in some municipal bonds, which are actually considered to be tax exempt. So they are going to be reporting $100 worth of tax exempt interest, as you'll see on their 1040 line 8A. And then we'll also have dividends and qualified dividends. The qualified dividends will actually be taxed at a different tax bracket. There's a capital gain tax that for up until the 15% tax bracket, it's taxed at 0%. From the 15 to the 39.6, it's taxed at 15%. And anything beyond the 39.6% tax bracket will have an effective rate of 20% tax. We also have made this individual self-employed, so we can consider them to maybe be working out of the HPP department on East Campus. We'll say that they do personal training services. They have had some cap gains, but this year they resulted in a cap loss. One thing that the United States tax law system does dictate is that you can only take $3,000 of a cap loss per tax return. So whether it's single or married filing joint, that is limited to a $3,000 capital loss. They did gamble throughout the year. They also endured some gambling losses. They also paid alimony from a previous marriage, incurred some student loan interest paid. They're paying off their student loans that they received from graduate school. However, they are remarried and their spouse is attending school, and they did have some qualified education expenses. What that includes is books, tuitions, fees, anything that is necessary to come to school, with the exception of room and board and transportation. They also contributed to an IRA. It's an amazing way to reduce your tax liability, and we'll show you how you're able to do that. And then off of the W-2s, we have both federal and state withholdings. Just a little background information on state withholdings is you're actually able to place that onto a Schedule A. So commonly, people are familiar with either long form or short form tax returns. If you're doing long form, you're probably going to be itemizing in a way. So the state withholdings will actually flow to the form that I provided to the judges, the Schedule A, and that will appear as a $3,500 deduction essentially towards the federal income tax liability. In addition, on that Schedule A, you'll find mortgage interest, medical expenses, charitable cash contributions in the amount of $750. Then let's also say that maybe they made a donation of clothing of $250 to Rainbow's End, and that had a fair market value of $250. We also see property taxes, unreimbursed business expenses, which I'm assuming many of our faculty here on campus would encounter. You can also itemize those deductions, as well as gambling losses to the extent of gambling winnings and ownership taxes for a vehicle. So let's just walk through the tax return and see how all of this would appear on there. So here we have our professor from Adams State and his significant other's tax return. It's John Doe, professor out of HPPE. We fill up the top, identifying who the taxpayer is, their spouse, being that it's married, filing joint return, fill in the social security numbers. One interesting thing about tax returns is they're directly traced to the Social Security Administration. So one vital component in making sure the tax return has been accurately filled out is making sure that the name on the tax return is spelled directly to the way it's spelled on the Social Security card. So we have their area of residence, which I identified as living at Adams State, as many of you do because you're so dedicated to your students. And you really wouldn't use that on a tax return, by the way, as being here in Alamosa, Colorado. So Taylor, I'll have you identify where all of our income and deductions went on the face of the 1040.
So our wages went on line 7. I'll just show you, you have it in front of you. Those that don't, I'm sorry, we apologize, as Alfred had mentioned. But so I want to focus on line 22 on the summation. So we have, as he mentioned, on line 13, the capital loss deduction. It's limited to $3,000 deduction, and anything greater than that would be carried forward into the next year and would be netted against any of that year's capital gains or losses. So we're limited there on the 3,000. He also mentioned on line 8B is the municipal bond interest is not taxable but is required to be reported to the IRS. As we skip down, let's jump into from lines 23 to 37. We show on line 27, a little later on, we're going to talk about the self-employment tax. That comes from your Schedule C. That tax is non-avoidable. If you have a Schedule C or you are self-employed, we'll talk to that a little bit later about the consequences, but as one tax that you are required to pay, and there's no necessary credit to redeem that. Once it's paid in, you can't get that one back. Self-employment is pretty harshly regulated. Other things within this, he shows the alimony paid. Alimony is deductible so that ex-spouse, the student loan interest, as well as the IRA deduction. On the IRA deduction, you can make that after the year end. You can contribute to that to lower if you think you're going to have a high tax for that year, you can contribute to an IRA to lessen the amount that you will pay in tax. So you can pay to a retirement account and be taxed on it at a later time, which is very convenient for those who plan to retire. I mean, I'm considering retiring, not soon, I'm just getting started, but for those that are considering retiring, you can contribute to an IRA and it'll be essentially a deduction from your taxes. As I mentioned earlier, line 37 is our adjusted gross income. That will carry forward to page 2, where the first comes off is your itemized deductions or your standard deduction. So your itemized deduction, I think Angel will be discussing more about itemized deductions, but that comes on a Schedule A. If your itemized deductions is greater than your standard deduction, then you get to take the greater of either your standard deduction or itemized. So it also lessens the amount that you're taxed on. And as Alfred mentioned, there's also the exemption amount, which is $4,000 in 2015, which in this case would be $8,000 deduction off your taxes.
So one thing I want to touch upon is we mentioned that this individual would be working for Adams State. So one of the glorious things about working for Adams State is that traditionally you're going to be contributing to an IRA and not necessarily, not an IRA, PERA, and not traditionally the Social Security. Now that's a great advantage. I've researched it quite a bit, and PERA right now is matching 18.5% of your gross income. That's phenomenal. You now in public working, you can maybe find an employer that's going to match 3% or match 3% of your contribution of gross income. So 18.5% is by far amazing. But by being self-employed and having this Schedule C, Taylor alluded to the idea that you're actually going to be paying in self-employment tax. So what self-employment tax consists of is Medicare and Social Security. If you're paying into Social Security, at some point you're going to be able to draw from Social Security, although that does have a stipulation. You have to pay in at least 40 quarters, equivalent to 10 years, to Social Security in order to be able to draw from that. So right now, if you were to do this self-employed income for 10 years or 40 quarters, you'd now be eligible to draw on 2 retirement pensions, PERA and Social Security. Now, he also alluded to the idea that you're going to be contributing to an IRA. The IRA contribution rate, as he said, is a wonderful way to tax plan and reduce the tax liability that you're going to have. And you can actually contribute any time before April 15th of the following tax year. So for 2014, if we see that we owe a tax liability, you can actually contribute up to $5,500 or $11,000, you're filing joint, before April 15th of this year to reduce your tax liability for last year. So if you're doing that, IRA stands for Individual Retirement Account, you're now going to be able to have 3 different types of retirement funds: PERA, Social Security, and an IRA account. The IRA is, you're able to withdraw from that at 59.5 without any penalty. If you choose to continue contributing to that beyond 51 years of age, you're able to contribute $6,000 or $16,000 or $6,500 or $13,000 married filing joint. It's a wonderful way to tax plan. You'll also see that your portion of self-employment tax in total is going to be $141 off of just $1,000 of self-employment income. So if you can reduce your tax liability as much as you can for income tax purposes, that's great, but you will be unable to evade the self-employment tax. So discussing the self-employment, the way that's set up is it flows onto a Schedule C. For this individual, Taylor will be discussing that more in depth, but they have a personal training business. As we said, they work in the Department of HPP. So they're going to be doing some personal training, and he's going to illustrate the different types of deductions that you can use to offset your gross receipts.
All right, so we're running short on time, but in general, I'm going to show you the difference between self-employment tax, Schedule C versus an S corp. So no time for S corp. So self-employment tax, it's a gnarly beast. If you can get away from self-employment, do it. Get onto it, elect into a corporation, and make the S election. As I mentioned earlier, self-employment is an unrefundable beast. So if you can get away from self-employment, please do so.
And your self-employment from Schedule C would be calculated on the Schedule SE. So as he said, due to the short amount of time that we're running on, we were going to illustrate the different tax scenarios that you'd be able to do to avoid that SE tax and pay it through a different entity, which would be the S corp. Here's the Schedule A that would have configured the amount that we would have itemized that was in excess of the standard deduction, as we're told we can do the greater of.
Okay, so right here are some adjustments that Colorado has made with taxes. First is the Gallagher, which was in 1982, and it impacted our homeowners' taxes. And basically, when home values grow faster than business values, homeowners pay proportionally less tax. And trying to go through this quickly for you guys. The big one everyone knows is Tabor. This one is restricting revenue for all levels of government, the state, local, and schools.
Very interestingly, Tabor also entails a lot more. So if you have any questions about either Gallagher, Tabor, or Amendment 23, be sure to ask us during the question section. So, do you have any comments or questions? Yes, ma'am.
I was actually really interested in that
what this illustrates is the different tax rates throughout the United States at a state tax level. As you can see, the United States is in the top 41%
Colorado is
what did I say?
United States.
Oh, Colorado is in they have one of the highest state income tax systems in comparison to a lot of the other states. Right now, Tabor is tried to delay the growth of that tax system, but it also has a lot of inequities and deficiencies when considering higher ed funding. And that's further into Amendment 23, and we can go into that if you would like. Angel, would you like to give us background on Amendment 23?
So Tabor basically cut majority of the funding to education, K-12 and higher. And Amendment 23 was guaranteeing minimum levels of funding for education instead of less. And it does it from the per pupil funding, but they have to keep pace with inflation rates. And that's about all I have on that one. But
Any other questions? Yes, ma'am.
How would somebody find out how many quarters they've paid into Social Security?
What you'd be able to do is you would be able to, first of all, look at past year tax returns. Let's see what your income looked like on those returns, and then we can also be able to pull your W-2s to observe and see if it was actually withheld and paid in. If that's not enough, we can also call the Social Security Administration and see if they have a quarterly report for how many quarters you paid. And then the benefits that you'll receive from Social Security are on you get a portion of what you paid in. So you can't necessarily get the same amount across the board as everyone else just because you paid in those 40 quarters. It's going to be proportional to what you actually paid in. Any others? Well, one thing I would like to suggest is the IRAs, and this is how I thought of it as myself doing my own research. As Taylor said, everyone is going to want to retire at some point. You guys are in very prime situations, having contributed to PERA. Like if you did work in the public sector, check and see if you actually did pay into Social Security for those 40 quarters, or look for a way that you may be able to still do that, whether it's being self-employed, just to reach that 40 quarter amount. But the IRA is a tremendous vehicle to being able to, I would say, retire, not in luxury, but retire comfortably. If you contribute in what you would like throughout the year, you know that you cannot withdraw from that without penalty until 59 and a half. So if you contribute with that idea that you're not going to touch it until 59 and a half, it's going to be receiving an interest accumulation of whatever the market value is. And for many of you, that'll be 20 years from now. You can draw from it at that point, live off your PERA, Social Security if you have access to it, and use that IRA account as maybe a travel account. Do it as your bucket list account. It's very much a wonderful